Most people start looking at homes before getting pre-approved, and that's one of the biggest mistakes you can make. Because you can be pre-approved and still get denied when you actually go to buy. And I've seen this happen more times than I can count. So in this video, I'm going to walk you through the right way to get pre-approved, the biggest mistakes to avoid that can kill your pre-approval, and how to make sure your approval actually holds up when it matters. Here's what usually happens. Someone talks to a realtor, starts looking at homes, falls in love with something, and only then do they start thinking about their financing. But at that point, it's already too late because now your expectations are set. Emotionally, you're attached, and if the numbers don't work, you're forced to either settle or walk away completely. And on top of that, a lot of people think that they're pre-approved when in reality, they're not. So they got a quick number online or had a quick conversation with a bank and they assume that's solid. Well, it's not. Let's clear this up because this is where most people get it wrong. Most people think a pre-approval is going online, plugging in some numbers, or having a quick chat with a bank and getting told you're pre-approved for this amount. And that is not a true pre-approval. That's just a rough estimate based on assumptions. A real pre-approval means a lender or broker has actually reviewed your credit report in detail, your income documents, your employment history, your down payment sources, and your existing debts and obligations. Because here's the reality, what you say your income is and what it actually counts for a lender can be two different things. Same thing with down payment. If you have large deposits, gifts, or funds moving between accounts, that all needs to be verified. And your credit, it's not just your score, it's how your credit is structured. Your limits, your balances, your payment history. So when someone says, I got pre-approved online, what they really got was a ballpark number. And that's exactly why deals fall apart later. Now here's something most people don't realize. A pre-approval is not just something you do when you're ready to buy. The smartest buyers do this 6 to 12 months in advance because a real pre-approval isn't just about getting a number, it's about building a plan. This is where you figure out how much income you actually need, how much down payment makes sense, what you need to address when it comes to your credit, and how to position yourself properly so that when you are ready, everything is clean, everything is structured, and you're not scrambling at the last minute. Here's how I'd break it down. If you're 1 to 2 years out, you should be in a planning mode and at least have a conversation with a mortgage professional. If you're 3 to 6 months out, you should have a real pre-approval in place already. And when you're ready to buy, that's when the lender does a full review of your file to give you a final approval. Most people skip the first 2 steps, and that's why they run into problems later. Now let's talk about how people accidentally kill their approval. Because this happens all the time. Taking on new debt, buying a car, financing furniture, racking up credit cards. Even if you can afford it, it increases your debt ratios and that can reduce how much you qualify for or kill the deal completely. So for example, a $500 monthly car payment can reduce your mortgage affordability by $100,000. Number 2, changing jobs or becoming newly self-employed. Even if it's for a higher income, lenders care about stability. So if you switch jobs right before buying, your file might be reassessed. And if the new income is accounted for differently, your pre-approval number may change or even result in a decline. Number 3, co-signing for someone. A lot of people don't realize this, but co-signing means that debt is now yours. Even if you're not making the payment, it still counts against you. Number 4, large unexplained deposits. If money shows up in your bank account, lenders need to know exactly where it came from. And if it can't be properly documented, they may not even allow you to use it. Number 5, missing payments and credit report errors. Even one missed payment can impact your credit enough to change your approval. But here's something a lot of people don't realize. Sometimes it's not even your fault. I've seen situations where something is misreported on a credit report, a missed payment that actually didn't happen, or an account showing incorrectly that should have been closed out years ago. And if you don't catch it early, it can lower your score and affect your approval without you even knowing. That's why it's so important to review your credit in detail ahead of time, not just look at the score, but actually go through everything line by line. So what should you actually be doing? Well, talk to a mortgage professional early, get documents properly reviewed, not just a quick quote, understand your true affordability, not just your max approval, because that's what a lender is willing to approve you, but may not be the number that is sustainable with your lifestyle. Prepare your documents early so there are no surprises, and keep everything stable, income, credit, and assets. Here's something most people don't talk about. A pre-approval is not a guarantee. It's just the first step. When you actually have a property, that's when the lender fully reviews everything again. And that's when issues show up. This is also why who you work with matters, because structuring a deal properly is different from just giving someone a number. I've seen situations where someone was pre-approved, then took on a small car loan, and suddenly they no longer qualified for the home that they wanted. Or they had funds that couldn't be verified and couldn't use that for their down payment. So these are small things, but they have big consequences. If you remember anything from this video, it's get advice early, don't start shopping before you're pre-approved, don't make any decisions that can change your financial position without running it by your mortgage professional, and understand that a pre-approval is not a final approval. Remember, a pre-approval is just a snapshot of your financial situation at that moment. If anything changes, your credit, your income, or down payment, it can affect your approval or even kill it entirely.